Sounds good.
Why don't you go ahead and take us away, Ken?
Okay, well, I'd like to welcome everybody to the Mid-Michigan Manifest Investing Roundtable for November. We do this every single month. It's a free program out there for anybody that wants to attend, and we've been doing this now for close to 7 years. The program basically is giving you some great stock ideas. We hope they're great sometimes, and also keeping track of the stocks that we choose. We have some goals, and as we go through the next couple of slides, I'll explain what those goals are. The first slide, however, is a disclaimer. Remember that we're doing everything for educational purposes. We're not making stock recommendations. We encourage you to do your own homework and make your own decisions. We might own some of the stocks we talk about in our own personal portfolios. We are recording this program, and it'll be posted on YouTube and on the Manifest Investing website. So if you don't agree with all this, as Mark says almost every time, then you have to leave right now. So here we are at our next slide then. And this is our agenda. It doesn't change a whole lot from time to time to time. We'll be looking at our results. We have always a question that we like to discuss a little bit, and tonight's question is, are markets overheated? And we're going to come at it from the point of view that that might be the wrong question to be asking at this particular time. We have a couple of companies on the hot seat. At the very bottom of our list, Echo Global Logistics and Chipotle Mexican Grill. And then you're going to hear presentations from at least Mark and myself. Hugh has chosen GE. If he's here this evening, he'll be making the presentation. And Cy Lynch has called in his choice of Priceline. And since we've chosen and talked about Priceline a whole bunch in the last couple of years, Cy felt that it was okay to put it into the mix and take another position in Priceline. We will take a poll at the end of the evening and decide which stock in the audience's opinion is the best one to add an extra position for, and then we'll have open questions and answers until we get too tired to ask any others or to answer any others. So one more click of the knob if you wish. These are our goals. We've been doing this for almost 7 years now, and the basic in 7.33. Okay, and the single focus of the program from the very beginning is to give people our favorite investment opportunities, but to keep track of those in something we call a tracking portfolio. Our goal is to beat the market by 5 points, to end up with a relative return of plus 5%, and that's versus the Wilshire 5000. We also have an accuracy goal. We'd like the ones that do beat the market, we'd like that to be up at least at 60%. And like I say, every single month we track that. We match it against what the Wilshire would have done with the same money invested in it for the same time periods. We do account for dividends, and here's the results up through November today. We are at an all-time high as far as this portfolio is concerned. Our relative return is 4%. That means we're beating the Wilshire 5000 by 4 percentage points since we began this thing over 7 years ago. The actual rate of return is 14.4%, which means that the entire stock market, as measured by the Wilshire 5000, has done a little bit less than 10.5% over that same period of time. Our outperformance accuracy is just under 50%. We'd like to move that to 60%, but we know what we're doing here is extremely rare. You're going to find very few ETFs or mutual funds that are able to maintain this kind of outperformance over this long a period of time. So we're quite proud of what we're doing, and
I'm,
we not only keep track
that's
of
me
it, but
knocking
we
on wood.
show you. We show knocking on wood, okay, and we show you on a spreadsheet how the stocks are doing. So I'm going to turn it over to Mark to take a look at our spreadsheet right now. Go on, Mark.
Well, I'm going to take us sideways for a minute,
That's great.
maybe 10 minutes.
Okay.
And kind of tackle this question because it's coming up almost every night on the nightly news with the Dow Jones Industrial Average in the news anchor's armpit still, and they talk about how much your 401k is soaring. Uh, we have had a good year. In fact, this is a look at the Standard & Poor's 500 measured by the SPY ETF, but it's the S&P 500 stocks over the last 10 years, and you can see that it's been a pretty good 10 years. The last year especially. And in the green box to the right, this is actually quite unprecedented. We are looking at the possibility here. There's more knocking on wood. More knocking on wood. We have never had 12 straight months with an up market without some type of a corrective moment or pause since 1941, and I think it even goes back before that. But certainly, since I only go back to 1941 for most things as the modern stock market, that is the case now, and it looks like we just might bring home a complete calendar year without a single down month. And again, very unprecedented. Up at the upper right, that arrow is just simply pointing that, what the rhinos, what the institutional analysts and all the people on Wall Street look at is this relative strength index. It's called RSI at stockcharts.com. Anytime that gets above 70, they refer to individual stocks or sectors, or in this case, an index of a market segment here, as being overbought. Quite overbought. It's actually up at almost 90. So that's why you hear a lot of fratter on the cable news and everything else that's going on. So it has been a hot market. I think this one shows things maybe a little bit less dramatically, and I think in this case, a little less drama is not a bad thing. I mean, we look at this long-term chart. This goes back to the year 2000. Those are quarterly price bars for the Value Line Arithmetic Average. So that's the 1,700 stocks that are in the Value Line Investment Survey Standard Edition. And when I look at that, I see points in time where that long-term blue trend line, which I think is actually a pretty reliable trend line, every once in a while the stock prices dip below it or maybe nudge up above it a little bit. But keep in mind that section right in the middle of the chart, around 2008, 2009, this is the biggest deficit in market history. These are some of the highest return forecasts up in the 20s that we've only seen them like 2 or 3 times in the last 30 or 40 years. So this was really kind of a special moment. But again, if you go back to some of the stuff that Cy Lynch talks about all the time, about in your rearview mirror, you go back far enough, bear markets become blips, and they just don't seem quite that nasty. This was a nasty moment in time, without any doubt, but it certainly wasn't terminal for most of us. Most of us did continue to invest regularly throughout that span, and grit our teeth and go shopping, and that actually turned out quite well for many of us. So again, this notion of how overheated is the market? Yeah, the return forecasts are down here. The green bars are a little bit above the blue line. Probably nothing fatal at this point. Another look at the same data, different set of stocks, about 2,400 companies here. This includes dividends. Again, the return forecasts are down a little bit towards, versus historical levels. The market shown in the background there has been zooming. But again, the point is, we all know with absolute certainty that stock prices fluctuate. Therefore, you also know that return forecasts fluctuate. And that's part of what we're seeing here. Again, in my opinion, not a life-threatening situation, and certainly not in a mind-altering situation either. And here's one of the other slides that we look at, and again, without getting too carried away with the stuff that goes on behind the scenes here, but what you're literally looking at is just an indicator that I find interesting as one more piece of a puzzle. People often say, Mark, well, when would you run for the hills? Well, first of all, I wouldn't. I would encourage mom and dad who are, getting along in the years a little bit, approaching 80 years of age, maybe they have a different situation. But for a young person, you don't even really need to think about asset allocating into cash or cash equivalents. You can try to do a little bit of it, as George Nicholson encouraged. But again, it's not something you need to worry about a whole lot. I would do that if this type of situation that we saw back in 2008, 2009 actually materialized again. And again, all you're looking at here is the number of new highs in the market, shown by these green areas, versus the new lows, and it's netted out. So anytime you've got a bunch of new lows companies making new lows in the market, these red lines just dive down. It's kind of like a domino effect. The thing that I pay the most attention to is this long-term moving average, this blue line that you see running through everything. You can see how much it cratered here, but here in the last few years, it's been pretty strong. It's pretty strong right now. And until that actually begins to really misbehave, as we saw back here, again, here's your stock market in the background here, this big dive down here. Until we get one of these moments like this, I really wouldn't worry about it too much. We're not there.
Mark, I'm going to break in and just ask a question, okay?
Mm-hmm.
Are you subscribed to a more robust version of StockCharts.com?
Yeah, I actually have a paid subscription, so I'm able to go back a few more years. For the free subscription, you can go back 3 years.
Well, what we're finding out on the free subscription is that you can no longer compare one stock to another on the same graph. Do you still have that ability in the paid subscription, Mark?
I'm sure I do. I've not tried to do it yet.
So I just want to send the answer out to those of you that have been asking about it. I got a call from headquarters today because I had mentioned that function had gone away somewhere around the first week in November. And headquarters wanted to know if I had any more information about it. I don't, but you folks that have noticed that you cannot compare one stock to another with the Stock Charts free subscription, you are correct. The actual button has actually disappeared from the StockCharts.com site. So if you're going to want to do some more robust kind of comps on the graphs, you might need to open up a subscription to Stock Charts. You might want to explore the possibility. I don't know, and I haven't tested whether or not I can do any of that on bigcharts.com, but I would at least urge you to give it a try, bigcharts.com, to see if you can do any comparing. Mark is using a version of Stock Charts that is part of the paid subscription to generate these types of graphs.
Yeah, and I'll take a look at that issue and put together a forum post on it that answers the question also and tries to offer an alternative if that indeed is the case. All right. And the next thing that we kind of like to take a look at, indicators as far as, no matter what the market is doing, this is a very powerful indicator. It's a lagging indicator, but what you're looking at here in the green area is employment. And the non-farm payroll employment over the years, going all the way back to 2004, you can see the recession there again. You can see the blue background is the market in the background. So that big dive down accompanied that tick down in the market or in the employment rate. And again, we've been, people have questioned the strength of the jobs and the relative average salaries and all that. But again, it's actually been fairly strong. And until that weakens, I wouldn't become terribly concerned about what the whole market is doing. Now, Ken will remember this. We got together for a book review online a little while back. That reference down at the bottom of the page, expectingalpha.com, and the numbers that you see there are to that book review. And we looked at Jim Cramer's Get Rich Carefully. That's where this idea came from. And I admitted to the audience that night, and it's actually in writing there, that I was skeptical when we actually started this book review. And first of all, it's worth the price of admission just for his commentary in the preface to the book. He talks about the dark pools and the high frequency trading and all that kind of stuff. This is a good book to get and pass around in an investment club. But he brought this idea of watching the non-farm payroll employment index, and it's a pretty valid thing to watch. So again, I wouldn't get too frightened about what's going on just based on that. Morningstar takes a look at whether they think pricing of their stocks are attractive across the board. Anytime it goes a little bit red, they think stocks are a little bit overpriced. You can see that they're there now. There have been times when it's been worse. Here's when they were the exact opposite back during the Great Recession. So again, they're not saying dramatically overpriced. Slightly overpriced might be the case. Here's some of what's been going on in the background. And this is the answer to the question, what actually happens during bear markets and recessions to our stocks? Is you do a stock study with a stock selection guide when you're in this gray area known as a recession, our stock selection guides get wrecked. Ken and I can remember looking at many wrecked stock selection guides back in the 2008-2009 timeframe because earnings had gone negative and nasty stuff was going on. But again, this longer term picture, and by the way, the right hand side of that is the forecasts according to Value Line for the industrials in the standard edition. The forecasts are pretty robust and they're not diminishing, not yet. So it'll be interesting to see what those continue to hold. That is what you're looking at on the screen is part of the reason that the stock market is in at least third gear right now. All right, here's just a quick reminder to everybody, especially those of you who may be like Lynn's students that are in the club up there, very early on in the investing experience. Sometimes you just got to remember, go shopping for excellent companies at a good price. The reason we put this up there is this is the 10-cup model portfolio that we feature at Manifest Investing. The reason I put it up there is it's 100% invested at all times. It doesn't try to do any market timing. It doesn't try to do any of that finesse type, nuance type stuff of trying to protect ourselves against the things that happen during recessions and bear markets. Because again, if you take a look at what the assets that are in the 10-cup portfolio were able to do coming out of this deepest, one of the worst periods in stock market history, we were basically back where we were within a couple of years. And you can see that the last few years have actually been quite strong. So again, 100% invested all the time, and look at the spread between those two. The red is the Wilshire 5000. So again, as Nicholson reminds us, find excellent companies, buy them when they're on sale, rinse, repeat, and get as many people around you to believe that as humanly possible, because you don't have to be sitting around being worried about the market all the time. Because here's what I think the right question is. Are our markets overpriced? Are they overheated? So what if they are? We don't buy markets. We simply don't buy markets. We buy great companies when they're on sale. And I guess the first time that I will become concerned about that is right here in the answer to that question, because I think the right question is, are there any companies, excellent companies that are on sale? So here's a current screen from just tonight. Are there any excellent companies with high return forecast? And the answer is yes. You can see size price line on there. You can see other companies that we have featured in recent months like CVS, Mercado Libre, Ulta Beauty, one of Ken's favorites, Gentex, Alliance Data recently. So if I ever sit down, ask myself that question, run this screen, and I don't get anything back, I get a blank screen back, that's different. I would react differently to that entire situation, and that's the right question. The right question is, can I find an excellent company on sale? And that's
Mark, I'd like to wander through a few of these questions that we have, Mark, because while they take a couple of side paths, they're very interesting and they all do relate. We have a question and a comment from Piero. Piero talks about continually investing, especially in good stocks when they're in the buy zone. And then he makes the suggestion that he wants to reinvest his dividends. Piero, I think one of the most misunderstood of the 4 principles from better investing is this one about reinvesting the dividends. The principle has nothing to do with putting that dividend money back into the stock that generated it. The principle has to do with making sure that cash doesn't disappear from the portfolio and using that cash to buy more stock, but only to buy stock that, again, is in the buy zone. A great example, I know that Coke throws off a dividend. I'm reasonably certain that Coca-Cola is not in the buy zone on a good SSG today, and therefore I would not reinvest the dividend that came from Coca-Cola back into Coca-Cola. I might reinvest it in some company that has a par value that's going to beat the market by 4 or 5 or more points. You also ask, is there any kind of software out there for investors? And I'm going to give a shameless plug to one of our friends. We don't make any money from the plug. We don't get paid to run an advertisement, but Matt Wilms in Quant9 software. The word is Quant, Q-U-A-N-T, and then the Roman numerals I-X for 9. Matt Wilms in Quant9 software runs a beautiful portfolio manager software that my wife and I have been using for almost 20 years now, and it will break everything down if you'll take the time to put the data into the program. If you want to know how well a $1.37 dividend did when you reinvested it in something, it'll keep track of that as long as you take the time to enter it into the system. So you can find that on the internet. Just look up Quant9, Q-U-A-N-T-I-X, Quant9 software, and look for the portfolio manager software. It's a great, my wife is telling me it's called the Investment Account Analyst. Investment Account Manager, okay? I'm getting a prompting in the background here.
Thanks,
okay?
Natalie.
Thank you, Natalie, everybody says, okay? Mark, could you go back to the chart with the red and the green, the up and the down arrows? And could you try to explain that once again? We're getting a lot of questions on whether and on the understanding of what that chart is really saying.
Okay, so from left to right, you're literally keeping track of the number of new highs in the stock market versus the number of new lows. So anytime that there's more highs than new lows, you're going to have the green situation up at the top, and you're usually chugging along pretty well here. The blue line through here is just a moving average over time, so that we can track it just simply. It's an average of the results over time, so we can follow it. So notice that, during this period of rise in the market from 2004 through Halloween 2007, everything was very healthy, trucking along, plenty of new highs. We got a couple hiccups. By the way, these hiccups that you see every year are kind of that technology swoon that happens almost every single summer. It's kind of a fascinating thing to watch and dig in a little bit deeper. So these single little spikes are very normal and natural. But when the wheels start to come off of the stock market, and you start setting more new lows, a lot of times it's like dominoes falling or leaves falling off of the maple tree, to make it more of a current example. And they start slowly, and the next thing you know, whoosh. And that's kind of what happened here in 2008, 2009. What I want everybody to notice is that for this particular indicator, and I'll include a link to some background, kind of the backstory on this, but what I want everybody to notice is that, the stock market was up in this range. You had literally 6 to 9 months after this began to dive down here to make corrective action. Sell some of your lower quality stocks, do some pruning, perhaps head into some cash equivalents if you want to try to nuance the investing a little bit. So you actually had a fair amount of time before this big topple down happened in late 2008, early 2009. So again, when the recovery starts, the market starts advancing back up, you return to here. And again, we've been in this situation for a number of years where the number of new highs has been exceeding the number of new lows, and we have not had a real threat. Think of it again as a domino type threat to the market since that 2009 timeframe. And there's certainly no signs of it all. One of the reasons that I take great comfort in this, again, it's just one piece that we look at, and we showed you some of the others, the Jim Cramer slide, and just the regular forecast slides that we do all the time with our SSGs. Back about a year ago, we'd had the national election. A whole bunch of investors in my area were panicking. They were concerned. A lot of the experts on TV, the talking heads, were talking about with the election of our new president, we were going to see 20, 30, 40% drops in the stock market. Well, we were looking at, our stock selection guides were getting stronger. We're looking at these numbers. This particular chart looked as strong as ever. And we were actually able to convince a bunch of people who were on the skids, ready to run for the hills or stuffed mattresses to stay involved in the market. Now you fast forward 1 year later, and we're looking at 20 to 30% returns for some of these people, and they're thrilled. And I'm happy that we were able to help them avoid that sick feeling after you stuffed the mattress a year ago and you miss out on what happened over the last year or so. So I hopefully that helps a little bit. I will include a link to some, like I say, the backstory on this on the Manifest forum and publish it on the blog also.
Mark, our community is absolutely wonderful, and I'm getting communication from Len in Michigan here that the perf charts are working again. Len, I will admit that we've been in contact with stock charts. I've been in contact with stock charts in the last week or 10 days to try to find out why that button disappeared. I have a strong suspicion it had something to do with the loss of the price charts coming from yahoo.com. That threw a monkey wrench into an awful lot of commercial sites. One of those commercial sites that it threw a monkey wrench into was our own toolkit. And many of you know that you had to do an update on your toolkit to get the prices to work again. I'm happy to see that button is now reappeared on the stock charts free version. So those of you that have been using it to compare, it appears you can still use it to compare. And that's just a new re-addition to the site in the last 24 or 36 hours. So Len, thank you for in real time testing that for us. We appreciate it. Michael would like to know, Mark, is the value line arithmetic average, is that based on means or medians or something else?
The value line arithmetic average is just simply an equally weighted average of all 1,700 stocks.
So it's a straightforward arithmetic average. It's not the mean or the median, either one then, right?
Right. And,
okay.
And it's not, when they deal with things like PE ratios, they will use medians because of how some of them misbehave when they get around zero. Earnings get around zero.
Okay. We're getting a question from Ram, and Ram, I think you've maybe missed the point of the screen that we're on right now. Ram wants to know if Stericycle is such a good idea, why isn't anybody buying it? This is not necessarily a list of stocks you should go out and buy. This is a list of stocks that have potential, and this is not potential as estimated by Mark Robertson or by Ken Kavula or by anybody else in Better Investing or Manifest Investing. These par values come from a consensus number that's generated by analysts. Mark likes to say, imagine all the analysts that follow Stericycle locked in a room and told they can't come out of that room until they come up with some consensus numbers for sales growth and for PE value, average PE value, and for net profit margins over the next 5 years. Well, then you take those consensus values and you make an SSG, just like all of us do on a regular basis, and you end up with these par values here. These numbers are based on the analyst's numbers, not something Mark just dreamed up out of his head or I just pulled out of a back pocket somewhere. These are the analyst's numbers, and all of the stocks on this list are not necessarily great ideas. But according to the analysts, they have some decent potential going forward. We advise you to do your own homework, make your own judgments, and to be honest, people that buy for mutual funds, many of them buy with the idea that they're looking at stocks that everybody else is buying. There are some really good mutual funds out there. There are some really, really good ETFs out there, but a lot of them have some issues with the kind of return they generate for the people that buy their funds. And so I don't know if that's a particularly good measure of how good a stock is. Mm. This is not a buy list that you're looking at, however. This is a list of pretty good ideas. Mark, would you agree with that?
Yeah, it's a shopping list. And I guess I would disagree ever so slightly that Stericycle is being bought by some people that I respect that seem to know what they're doing over the long term. And just a little deeper on Stericycle, since it is a roundtable stock, it has been hammered pretty well since the acquisition of Shred-it, and they've had some issues slash challenges slash opportunities for doing things better with respect to their IT systems and their enterprise-wide systems and their documentation and all that. People who follow the situation fairly closely believe that they may be getting a handle on that. And these guys are really, really solid, strong, muscular gorillas in the field that they're in. And if they do get a handle on that, they could become quite formidable. And there are people, again, taking positions in Stericycle that believe that could be happening. Now, turnarounds are tough. So I'm just saying that it's a shopping list. Study carefully, study closer.
Yeah, and just to keep everybody comfortable out there, Mark, you and I are not disagreeing at all about Stericycle. It's a little bit risky for some people, for some accounts, but I agree with you that there's a strong potential for a great turnaround. These managers knew how to deal with sharp disposal for a long time and did wonderful things. They're kind of like a python right now swallowing a goat, and they're trying to get this thing digested, this Shred-it acquisition digested, so that they can begin to run higher margins on the shredding of documents and all other kind of things. Stericycle needed to expand its business, and that's the way it chose to do it. If they're successful, there's a whole bunch of potential in this particular company. The management has proved that they can turn the top line into the bottom line, and they need to prove it again. They've been a little shaky for the last couple of years, but you're right, they are beginning to turn the corner on some of these things with no problem. Our friend Len from Michigan is telling us that there are some other great charting sites if you're interested, folks. One of them is at FinViz, Finviz, and one of them is at Guru Focus, Guru Focus. So if you're looking for charting sites, stockcharts.com, bigcharts.com, FinViz, Guru Focus, and I'm sure that if I turned Len loose, he would give me a list of 8 others as well. Len, I don't need them, okay? But thank you so much for helping out on that particular question.
We better trek on to the actual portfolio, spend a couple of minutes talking about stocks that could be trimmed. So Ken, let's go ahead and take it to the next section here. This is a look at the tracking portfolio. These are the top 20 holdings by total assets, or actually dollars for the various positions. And you can see the entire tracking portfolio using that link at the top of the page. The legend at the bottom gives you the story behind how many times the various stocks have been selected. So for example, Cognizant Technology at the top has been selected 12 times. Every time it's selected by one of us during a presentation or the audience vote, we put $1,000 into it. So $12,000 into Cognizant is now worth $22,206. The one that we find fascinating is All Get Out, and it's part of the reason that we are up to a 4% relative return, is the second one on the list, Universal Display. Many of you here will remember that's been selected just on one night by 3 different entities, Ken, myself, and the audience. $3,000 invested in Universal Display has become $21,500, and we're pretty thrilled about that. It's threatening to become the largest position in the portfolio. It's also having a tough time staying off the hot seat. We'll talk about that in a minute.
And Mark, it's such a great example that you don't have to hit 50 home runs to really impact your portfolio, that you can have a lot of strikeouts, and if you have one home run, it can balance out a really long list of strikeouts. That's just amazing that here's Cognizant with 12 choices, $12,000 put into it, and it's doing quite well. It's almost doubled itself, but here's OLED that only has 3,000 in to it, so it's more than a 7-bagger at this particular point. You don't have to hit that many home runs to really impact your portfolio in an extremely positive way.
Yeah, so you can have some fun looking down the list. Kim recently bought LGI Homes, and the audience seconded it. That's only $3,000 within the last year or so, is now up to $6,200. So I mean, some good stuff there. So let's go ahead and talk about we look at least two dimensions. We're looking at adding a third here, and we'll be talking more about that in upcoming months. But the first rule that we follow when we're talking about selling stocks to improve, because let's go back and take a look. The quality's fine on the portfolio. The growth rate is actually pretty good. We want to see that average out to be approximately 11%. Quality is fine. It's excellent. But our projected annual return, the return forecast for the entire portfolio is a little bit low. So we probably do want to do some trimming. We want to trim some of the lower return forecasts and continue to bring higher return forecasts. And you'll see that in the companies presented tonight. Number one on the hot seat tonight, and it's the only one we're going to talk about tonight, is Echo, because I can't bring myself to talk about OLED as a sell yet. We want to get at least one more update cycle in that, and hopefully it won't go south. But Echo Logistics has been through a real meat grinder and come out the other side. And now, even with fairly optimistic projections, it's got a fairly low par. We'll take a look at that in some detail right here. You can see that Echo was trucking along pretty well, and then they had a speed bump that you can see there in their earnings trend in 2015 and 2016. The price was not damaged that badly by that big of a hiccup, and it's actually recovered fairly nicely into the mid-20s range. But in the mid-20s with an 11% growth rate and a fairly reasonable profitability projection, fairly decent or ambitious PE, we're still only talking about mid-single digits for a return forecast. So this is one that I think we could probably go ahead and part with, Ken.
How many times have we put a position in Echo, Mark? Do we have that down?
I don't know off the top of my head, and I really don't want to jump out to look right now, but I think it's just
okay.
It's just a couple. I can look back here.
I'm perfectly willing to freeze that position.
It's a
folks. This is a tracking portfolio, so it has many more stocks than an actual portfolio would have in it. We're trying to show you our choices and how well they would have done. And when we freeze a position, then whatever gain we have or whatever loss we have stays with the portfolio. This isn't like reinvesting the cash somewhere else, however. So we're just going to freeze this position. And since there's only two of us at the round table tonight, Mark, the motion probably will carry 2-0 then, right?
Yeah, it just keeps the total number down. And again, we can always come back to this or something related to it. The other one that we're going to probably jettison, and I don't think we have a choice here, is Chipotle. We didn't pull the trigger on this one when we should have. We actually thought about this a few months ago. We have a selling discipline that we're trying to follow more closely. We're just learning. We're learning this discipline, and sometimes learning a new discipline can be quite undisciplined. What you're looking at here is a comparison, the same type of thing that Ken and Len and the others were talking about, only this time I was using big charts, comparing the performance of Chipotle, CMG, that's the black line, versus that kind of brownish line, that's the Wilshire 5000 measured by VTSMX. And when you compare two stocks at big charts, you end up with a percent comparison on the right-hand side. So anytime we get two of these boxes away on the two, and you can see right where I put the red arrows, that's where Chipotle fell 20% behind, and that was at the end of July 2017. We should have jettisoned it by our rule of five based rule. And again, for those, you guys have been around for a long time, it never hurts to remind that what we're really doing here is just leaning on that time-honored suggestion that for every 5 stocks that you develop expectations for and become owners of, one will dramatically outperform your expectations, kind of like Universal Display we were just celebrating. 3 out of the 5 stocks will do pretty much what you expect, and one, for reasons perhaps unknowable, will underperform your expectations, and sometimes you just have to give them a timeout. Here's a timeout that should have happened on Chipotle because, again, within the last few weeks, they had another celebrity hospitalized after a Chipotle visit. I don't know whether it was a sensational moment or not, but you can see what happened to the stock price. And they've been wrestling with some issues for quite some time. So I'm thinking we walk away from that one also, Ken, just for
no problems with that either, Mark.
For the sake of practicing the discipline.
And I'm becoming a firmer and firmer believer that what we're onto is making a lot of sense. I mean, I would have much rather have liked selling Chipotle where the Red Arrow is rather than selling it where it is today. So we're finding all kinds of good backup material, good rationale for why this new twist on our selling discipline is really a great thing for us to be thinking about.
I think so. All right. Any other questions at this point, or should we transition into the stocks for this evening?
I think we're ready to go there. We're pretty well caught up on the question box
Okay.
at the moment, so let's move to McKesson.
All right. Well, I hope everybody enjoyed the lecture on the stock market putting in new highs. And again, we're talking about going shopping for outstanding, excellent companies that are priced attractively. And I think this one qualifies. This is kind of a flash in the pan. It's only been around for a little while. It started in New York back in 1833. So the company's been around quite a while. And it's literally a story of, I don't even think they think of it this way, but it is truly a vertical integration concept where these guys serve all parts of the healthcare delivery system and consumer system for healthcare products in the United States, for that matter, the world. You can see, as it says in the inset there, that 50% of U.S. hospitals, 20% of all physicians are served by McKesson. And you can see, even though it's not dramatic, I think we can make a claim for up, straight, and parallel. And this is a company that has survived many wars. In fact, if you want to go back to the 1930s, these guys were infamous for an accounting scandal which nearly killed the company. And in fact, inspired all kinds of reform activity with respect to accounting. And then they did it again back in like the 1960s with one of their subsidiaries. So, I mean, this company has been tested and has survived, obviously, for almost 200 years now. Just a quick moment for the type of stuff that they do. And this is why I think of it as a vertical integration thing, from the patients to the hospitals, to the drugstores, to the drug companies, to the companies that do record keeping and billing and keeping track. You can actually boil the company down into they're a distributor. They're a deliverer of supplies and stuff for healthcare, including drugs. And then they're also kind of like taking one of the companies that we know follows healthcare, like a Maximus, for example. They also do the technology or the science behind the consulting end of the business also. So you're getting kind of a twofer here. You're getting the vertically integrated product and supply and service deliverer along with this technology supplier or consultant when you're talking about McKesson. I'll let you read what they actually do. I mean, this is a company that supports medicines, drugs, surgery, all kinds of stuff that you would have in clinic or in hospital. They're focusing quite a bit on oncology, treatment of cancer these days. They do all this kind of stuff, reaching patients and trying to improve life in all kinds of different venues. They have two principal competitors, and we actually like both of them too. I mean, Cardinal Health has been a community favorite for better investing audiences for decades, and AmerisourceBergen. Amerisource is the third competitor, and it really is kind of a three-horse race when it comes to this general industry. One more infographic just to drive home the point of these guys are integrated across all segments of the supply chain for healthcare, all kinds of pharmaceuticals, pharmacies. One of the biggest companies in the country, a couple 100,000 physicians use their stuff. So these guys are definitely present. Here's a quick look at some of the numbers. Again, I would argue it's fairly up, straight, and parallel. It's not exciting growth, but again, we're talking about growth of a $200 billion company in the 7 to 8% range. And again, just take a step back from the trees. I think that there will be some pressures on healthcare. I do think at some point there's going to be some cost containment, but these guys are leveraged in along the whole shooting match. So again, it's a fairly natural thing for them to be growing in mid-single digits. Now, this 1.5% profit margin might seem too small to many, but that's simply the business that they operate in. That is actually a very strong profit margin level compared to some of the minor players in the business. And if you compare them to Cardinal or Amerisos, these are reasonable numbers. And I want you to notice the trend on the scale down here, the picture of profitability, net margin over the last 10 years, along with a few years of forward-looking estimates. Very strong trend, very consistent on the amount of profitability, and that's a pretty good number all in all. Now, where the analysts might be coming in at a PE of 16, I chose 14. You're still looking at, even with more conservative assumptions, you're looking at a mid-teens return forecast for the company, a PE somewhere in that 15 range. It all just seems to make a whole lot of sense to me, and really like the picture I'm seeing. So again, just to reinforce the numbers, if you look at the most recent value line from a week ago, 11% growth, we actually are going with something more closer to what we think the industry globally looks like. So again, in that 7 or 8% range for that. I think the margin is an appropriate number, slightly less on the PE. Those three figures are what add up to give you your return forecast. And again, I would be looking to buy this below. Very high quality company, I'd be willing to settle for a slightly lower return. 13.5% return actually occurs at 159. We're there. So this is at a fairly attractive price level, historically speaking. Here's a look at the Chronicle. Again, what you're looking at here, the green bars are monthly price bars. The blue line is the quality EKG. That's up in the excellent zone and fairly straight lining. And again, the return forecast, thanks to a kind of a slumping or a swooning of the stock price over the last couple of years, while the fundamentals have been improving, results in a return forecast that has been actually strengthening and is at one of the two best purchase times. You can see if we'd locked in on this one here, we'd actually feel pretty good about it, even though the stock price has been fairly flat. So again, I think this one adds up. I see this appearing on some of the most respected small company mutual funds, believe it or not. And when we were looking around at some of the sources for ideas here in the last couple of months, it's one of the top ideas for Chris Jenner, the guy that used to run the T. Rowe Price Health Sciences Fund. So we're in pretty good company with the attention that we're lavishing on McKesson under these conditions. So I'm going to go ahead and add that to the portfolio and knock on wood and hope for the best, Ken.
Thank you, Mark. I'm going to present Norwegian Cruise Lines Holdings. And here's a picture of one of their newest ships in Norwegian Cruise Lines. So if you go to the next slide, Mark.
That's almost like a hippie cruiser.
Norwegian Cruise Lines has a large number of ships, although it is the smallest major cruise line company that exists around the world. You know that it has competition from Royal Caribbean and from a couple of the other larger cruise lines. About 50,000 berths on the ships. 7 new ships coming, one a year for the next 7 years, and that will add almost 40%, a little bit better than 40% more berths to their total. They visit over 500 different ports in the last fiscal year, carried more than 2 million passengers, and employ about 30,000 people throughout their 25 ships. So these are truly small cities, as large as a lot of the small towns in the Midwest, small cities floating on the water. Click again, Mark. They operate with 3 different brand names. Besides the Norwegian Cruise Lines brand, they also are operating Oceania Cruises and Regent Cruises. You can see that these are fewer ships in the other brands, and these are thought of as more premium brands. They're more expensive. They have more amenities attached to them. The ships are a little bit fancier when you're all said and done, but all of these ships are relatively new, and they all have something to give you pause for a really great experience on the water. They've announced their entry into China, and they're building a new ship just specifically aimed at cruising in China, not only in the oceans off of China's coast, but up some of the major rivers. So they're going to have some different types of vessels. They're called Breakaway Plus class vessels. And I'm getting these slides that you're looking at right now right from the Norwegian Cruise Lines website. This is a really nice long presentation to give you an idea of how they think they're going to grow and what their business is going to be. You might want to go there because I've just abstracted 8 or 10 of the slides to give you a taste of what the company is doing. Next slide, please. Here's one of the experiences that you can experience on some of their new ships. Yes, that actually is a racetrack, and those are actual passengers riding little cars. You know, you can call them what you want, but they can race those things. The track actually goes off the edges of the ship and gives you quite an experience as you come around some of these hairpin turns. I'm reading the hype that comes with the racetrack. But they're aiming at a younger audience that usually has cruised. And in fact, the average age of a cruiser on Norwegian Cruise Line ships tends to be much younger than the average age of people that are cruising on some of the larger lines in the Caribbean. Slide again.
Well, I just want to say I almost lost my dinner on this one, so.
All right. They've also begun service to Cuba. Now, there's been a little bit of a hiccup with travel to Cuba, but the cruise lines were that had set up their ports of call and their various itineraries were grandfathered in. So even with the new regulations coming from our own government about travel to Cuba, Norwegian Cruise Lines is going to be able to make its sailings into Cuba and to keep all the dates that it had set and the reservations that had been made. Next slide. They're also developing a brand new port of call called Harvest Key, and it's in southern Belize. It'll be a completely new destination for cruising in the Western Caribbean. And Belize is a very popular port of call for Caribbean cruising, and this is going to be full of brand new resorts and a lot of the typical types of experiences that you can find in the Western Caribbean. Click again, Mark. The Norwegian Bliss is a brand new ship that was developed especially for cruising into Alaska. There's a picture of it. And Norwegian is betting big time that Alaskan cruising is going to continue to be a kind of a business that attracts a lot of different types of people, a lot of different age groups. And the Breakaway is the best booked ship in terms of load and price prior to the first sail date. This one is going to sail first in May of 2018, and it's the best booked ship in the Norwegian Cruise Line at this time for 2018. So the Alaska business is extremely strong for this cruise line. Slide again, Mark. The next generation of ships, I indicated there's going to be one coming every year for the next 7 years. They're delivering all the way through 2025. They have options to deliver in 2026 and 2027. They are not backing away from adding ships to their fleet, and that's how they expect to extend their growth by adding more and more ships, more and more berths, and consequently more and more top line, and we hope bottom line earnings. Next click. This company's only been publicly traded for 16 quarters. So if you count from the right on this graph, 16 of the bars, that's publicly traded, but the company's been around for an awful long time, and they've managed to show 35 quarters of consistent earnings growth. That's certainly what we like to see in a growth company. Again, only 4 years publicly traded, but a very long, stable history prior to them becoming public. Click again. The fleet expansion is going as as they laid out 3 years ago. And again, they're operating in 3 distinct divisions: the Norwegian Cruise Lines, the Regent, and the Oceania. And here you can see the ships that are scheduled and when they're going to be added to the fleet, all the way from next year all the way through 2025. Click again. I always get the question, well, they have to borrow a lot of money, don't they, to build these ships? And the answer is absolutely yes. This is a capital-intensive industry, but I captured this particular screenshot just to show you the interest rates that these people are paying to build these ships. I mean, if these are pretty decent interest rates, and in this low interest rate environment, they've been able to hold these interest rates down so that they're paying, in the case of the Norwegian next generation class, their average interest rate for these 4 vessels they're going to build is somewhere around 2% or so. So they're not paying a lot of money in interest, but they are showing that these ships are expensive, as you'll see in their debt to capital numbers coming up in just a bit here. Click again, Mark. Here's what we would expect out of 4 years. I'm looking at lines that are definitely moving in the right direction. The most recent 3 quarters are certainly moving in a nice direction. I do see 2-year sales estimates. I see a long-term 5-year EPS estimate off to the right over there. And there's not too much for me not to like in this particular visual analysis. I also like it when I see sales and earnings that are moving up and price lines that have tended to stall just a little bit. If you look at the price lines from 2015, 16, and then the current 2017 price lines, you'll notice that the tops of them are reasonably flat. They don't have the same slope as the sales of the earnings, and that says to me that the stock has a little bit of catch up to do. And as people discover this stock, I think there's a lot of room for PE expansion, and that's going to give me a boost up on what the potential for the stock might be. Click again, Mark. Here's what you're used to seeing at the bottom of the SSG Plus. I've estimated growth into the future for sales of 10%. I've estimated earnings per share growth at 12%, and that's really on the conservative side when you look at earnings estimates from any of the sources that we usually read. Pre-tax profits certainly headed in the right direction, 13% compared to a 5-year average of 9%. Return on equity, not as clean a number as I would like it to be because of the high debt number. But again, this company experiences high amounts of debt because it's extremely capital intensive. They build their ships and then own those ships, and they have to put a lot of money into those ships. Very capital intensive industry. We're still at about 58% in the most recent year, and that compares almost exactly to the 5-year average for debt. Click again, Mark. I'm looking at the traditional section 3, and I discounted the high average and the low average in the first year of operations. They seem to be much, much higher than I would expect. I tended to look then at the 3-year averages that are calculated there in the tool and decided that they were a little bit on the high side. So I'm looking at judgments that I used of 22 and 12 going forward. I'm looking at the current PE ratio, and that's around 17 right now, 16.9 if you look at it at the bottom of the block on the top, and that's just about in the middle of my 22 and 12, so I'm feeling pretty comfortable about that. Using the judgments that I've given you, this is a buy. It has a potential price appreciation of about 130%. That means its par value is going to be somewhere greater than 15%. Total appreciation of 100 would give me a par of around 15. Upside, downside, 4, 5 to 1. That's well within a reasonable range. One more click if you would, Mark. And here's the summary of the entire SSG: a low projected value, a par value of 12.2, a total return value of 18. And again, I usually like to think of my return as coming somewhere in between those two numbers. So 12 to 18%, I'm very comfortable with that kind of return out of this size company. Click again, please. I was very pleased to see when I went to the value line, and that was one of the first places I went to after the company website, that Mr. Nicholson probably would be calling this a triple play. Look at what I consider to be stock prices that are depressed, and the way that I measure a depressed stock price is by looking at total return prices. Value Line is suggesting at the low that you should get around 11%, at the high around 24. When I see numbers that are more than 5 or 6 at the low side above the market, I think that's telling me that I have a slightly depressed stock price. The current PE of around 12.1 is almost smack on because the current price is very, very close to that 54.66 that the 12.1 is based on. I compare that to Value Line's call 3 to 5 years in the future, which is around 16. There's that PE expansion that I was talking about, coming from the growth and coming from the fact that this company is not especially well discovered by the investing community right now. I look at profit margins and I notice that the most recent actual profit margin, and remember that we're looking at regular type, is a little bit under 14%, and Value Line is suggesting that margins can move as high as 17+% in 3 to 5 years. That's the 3 legs of the triple play. That doesn't make this an automatic buy, but it certainly moves it to the top of a let's study this company kind of a list. I like what I'm seeing from the Value Line report. One more click, Mark. I moved to the annual rates box. Remember, I pegged sales at 10%. I pegged earnings at 12%, and Value Line is significantly more optimistic than I am, with sales growing in the next 3 to 5 years at 15% and earnings at 28%. I love this last paragraph. I don't usually get a twofer. Where Value Line is telling me this is an above average stock for the next year, and it's also a great stock for the long run, the next 3 to 5 years. But that's exactly what Mr. Platts is saying, that this might be a twofer. This is a relatively recent Value Line coming from November 3rd. So again, I'm not seeing anything I don't like. One more click if you would, Mark. Here I've gone to the Norwegian Cruise Lines page on Manifest Investing, and I note that Mark is suggesting a par of about 13%. That's awfully close to the par that I calculated on my SSG. So Manifest is validating and verifying my own analysis. This is a good, high-quality company. I'm looking at the numbers. I notice that the analyst consensus numbers for sales growth are very close to where I am, 10.3. I used 10 for my analysis. And all in all, I think that I'm getting an analysis that makes me extremely comfortable. One more click, Mark. Whoops, I thought I had one more slide. I'm all done, so I'm going to suggest that we put another position in Norwegian Cruise Lines Holding, NCLH.
Good stuff. Looks like a good stock to recommend back in September 2016, huh?
Mark recommended this stock a little bit more than a year ago, and it's had a wonderful, wonderful run up to this point. And both of us are going to cross our fingers that it has a continued great run for the next year.
Well, we certainly second the notion of Alaska cruises being a good idea, having both done them, and we continue to think about cruises in our future. So keep your ears open for that. Hugh McManus apparently is unable to join us tonight, but he continues to be stubborn about GE. He thinks all the stuff going on with GE continues to be stuff that was basically expected as they rationalize and try to make the new business under the new leadership. And he's just going to continue to be stubborn on GE. By the way, it actually has triggered the 20% limit, so we're going to give it a variance at least for a few months, Ken. I think most of the selections of GE are down 25 to 30% more than the market here over the last few months as the loathing continues. In fact, I noticed no less than a half dozen really nasty articles about GE just this morning. So I mean, it continues. And then
I can live with it staying, for one more month. But if we continue to trigger our new philosophy, we need to have a serious talk about it at the next roundtable. I think.
I completely agree because I mean, that one's under a lot of pressure. And then Cy also wanted to, by proxy, bring Priceline. It's been one that we've talked about many times. Quality EKG is flat and excellent, and it still ranks as a fairly decent return forecast in the mid-teens. Just a formidable participant in this industry. So he'd like to go ahead and add to Priceline. So we wanted to give you guys more options to vote on just the two because I couldn't stand having Ken crush me in a head-to-head competition.
Okay.
How's that for a rationale for doing the poll? So why don't we go ahead and do the poll?
All right. Are you going for the pity vote tonight, Mark? Is that what you're doing, huh?
All right. No, the pity. There's lots of room for the pity vote in this situation.
All right. So let me
the audience on Saturday.
Let me launch the poll.
No, I think they're both.
And folks, all you have to do is press a button. And when we get up to, maybe 70, 80, 85% of you voting, we'll close the poll. We're already at 70%. So if you just take your mouse and press a button, or if you're on a touchpad, move it over there. We just crossed the 80% threshold. I'll give you about a count of 5 if you haven't voted yet. Give us a vote. That'll help out a little bit. And I'm going to close, and I'm going to share the results. Okay?
Let me guess.
Yeah, it's Norwegian Cruise Lines, Mark.
Of course it is. Well, okay. I'm sort of a partial winner here because, I did bring it a little while back.
Okay, so we're going to add 2 positions to Norwegian Cruise Lines, 1 position each for General Electric, McKesson, and Priceline, and they'll be added to the tracking portfolio. Let me hide the results, and you can move to the next slide then, Mark.
All right, so just a couple things. We're obviously into the holiday season. We want to wish everybody a happy Thanksgiving here in a few days. We are going to do a Turnout Tuesday on December 5th. That's Tuesday. And what we're going to do, and we've already got a few really solid questions we want to tackle the mailbag. And if you have any questions, you can send them to either Ken or myself or post them in the Manifest forum, and we'd be happy to tackle them. The December roundtable is scheduled for December 19th. Ken, are we okay with that, you think? That's 6 days before Christmas. Everybody will be right?
We'll give it a try and see what happens, Mark, Okay.
I'll start my shopping after we end the session, so I'll still have plenty of time then. And I just wanted to point out, though, we've got other stuff between now and May, but I just wanted to point out that Ken and I will both be in Orlando at the Better Investing National Convention in May, and it's in mid-May, so there'll be more information on that. So with that, Ken, I think we can probably sign off and or at least shut down the recording and address some questions.
Okay, we do have